So why do you think, then, that this weakness is unwarranted in the dollar? Why do we go back to a stronger dollar?
Well, I think specifically with the dollar, a lot of this is positioning. If you look at our positioning indicator, we've now seen those dollar longs that have started since President Trump was elected on November 8th effectively come out of the market. So the point here is the market is no longer pricing anything in as far as a Trump rally in the dollar. If we broaden the discussion out a bit further to, say, bond markets, equity markets, and foreign exchange, this is where we think it's interesting. We don't think the market is pricing in enough as far as the Fed is concerned. And we would say it's not just the fiscal stimulus that is coming from Donald Trump. It's the current state of the economy, and very specifically, inflation. It's already starting to pick up. So it's going to be very interesting to listen to Janet Yellen this week to see what she has to say. Could she become more hawkish? Could she suggest that, irrelevant of, shall we say, fuel being thrown on the fire in the form of fiscal stimulus later in the year, right here and now, growth is strong, stronger than anticipated, and inflation is picking up?
So many people would argue that, of course, how can they get out and further ahead and more aggressive because they don't know what the fiscal stimulus, or for that matter, what the tax policies are going to be. How much more aggressive should they be, in your view, or could they be this year?
Well, this is a key...
Because they're telling us 3.
Yes. This is a key point. Remember, the market's not pricing 3. So
no, the market's not.
Difference between the Fed and the market, and I would tend to go with the Fed. I think the key point is to listen to Janet Yellen to see how she responds to the fact we have US CPI at 2.1% already. We have unemployment at or below Nauru, and we have growth coming out stronger than anticipated in both Q3 and Q4. So I think you're very right to say the Fed doesn't know what's coming as far as fiscal stimulus is concerned, but I think the Fed may be more interested in actually what's happening here and now, but they've still got in the back of their mind that there is likely to be some fiscal stimulus coming later in the year.
So in the days to come, days and weeks to come, do we see the Fed trying to put March very much onto the radar? Because if they're going to do 3, if they think they're going to do 3, they need to start soonish.
Well, I think that's a strong likelihood that the market needs to price more in. And if we come back to where we started the discussion on the dollar, I think this could be an opportunity. Our view at BNP Paribas is there's 3 very nice trades out there in the dollar. We think the best ones are clearly dollar yen. Remember, we're targeting 128 by the end of this year. This is a good opportunity. We like short euro dollar as well, given the still dovish policy coming from Mr. Draghi. And also in the commodity block, we actually like long dollar versus the Canadian dollar. So it's quite a broad spread here, but we think now is a great opportunity, particularly given that a lot of that positioning has come out of the market.
You mentioned the Canadian dollar. Let me just show you the positioning. This is on commodity currencies, and it has shifted quite dramatically. I mean, we can talk about the peso in a moment, but this is, of course, the hedge funds are bullish again on commodity currencies. There's a big sort of turnaround here. How does that sit with you guys?
This is an interesting one. Well, as I said in my statement, let's broaden this out to equity markets, bond markets, and currencies. I'd like to link the commodity block actually to equity markets. And this is quite interesting. Our internal models, our proprietary models at BNP, our shortest term one is called BNP Paribas Steer, and that not only gives us valuation on currencies, it tells us what is driving currencies at any given point. And what it's telling us, or actually screaming to us at the moment, that particularly Australian dollar and New Zealand dollar have a very high correlation to global equities. So it's this risk on, risk off. So my point would be, the Dow seems to be struggling, or S&P 500 seems to be struggling at these levels. If we do see more Fed tightening coming in, if we do see equity markets come off, global equities particularly, the best way to play that in foreign exchange, I would argue...
Short Aussie, short?
Exactly, short Kiwi.
And that also stands if we see markets becoming increasingly concerned about trade, particularly the Chinese part of the equation. We've seen Donald Trump, of course, very active on the Mexican front. We've seen him very active now on immigration policy to various countries in Africa and the Middle East. We haven't had any executive orders around China as yet, but if that becomes a big issue, then surely the Australian dollar is in the firing line there.
Well, yes, this is the $64,000 question, or probably more than $64,000 these days. But
couple of trillion there, Stephen. Couple of trillion.
We've already seen this with TPP, and Australia's focus here was to try and go ahead without the US. So they wanted TPP maybe with China, but without the US. So this is a key theme for Australia. Obviously, China is its biggest trading partner. The currency is very elevated. If we do get weakness, in the S&P 500 and trade issues, the Australian dollar looks very vulnerable.